option B can allow more money to be paid into an IUL, but beware. In this episode, I'm going to answer the question, what is option B in universal life? And I'll give you some clues on when you should use it and when you shouldn't use it. Get ready. You're going to understand some things that even life insurance agents don't understand. So my name's Doug Andrew. I've been doing this for more than 46 years. I got my insurance license clear back in 1974. And one of my favorite vehicles to accumulate money tax-free and then allow you to access money tax-free at actual historical rates of return of 6 to 10% net has been maximum funded indexed universal life insurance contracts. So when people ask that question, what is option B? They must at least know they're talking about universal life. So most insurance companies say that option B, there's two options, option A, option B. Option B is what is called the increasing death benefit option. Now, there's a couple of outliers out there, insurance companies, that's option A. But generally speaking, I would say over 95% of insurance companies say that option B is the increasing death benefit, whereas option A would be called the level death benefit. And I'm going to show you when you should use one versus the other. So let me explain this. And if you're a little bit confused, I want you to stay with me, or you can click on the link below and get a copy of my 300-page best-selling book, The Laser Fund. I'll pay for the book. You just pay $5.95 shipping and handling, and you can learn more detail about this. But when you set up a universal life insurance policy for what it was originally designed for, living benefits, more than even the death benefit, then you're trying to get the most premium into the policy as fast as the IRS allows for the least amount of death benefit they will let you get away with. And so you're trying to put in the most money. So let me simplify this. It doesn't matter if you're socking away $1,000 a month, $10,000 a year, $100,000 a year, $1 million, $10 million. Let's use a $500,000 example. So if you want to be grandfathered or allowed to pay into a universal life insurance policy, a grand total of $500,000, you used to, in 1980, be able to put that in one fell swoop. And if you were earning 10%, which many were back then, from 1980 to 1990, I had clients put in $500,000 and they started pulling out $50,000 a year tax-free, their interest, and they've been doing it ever since without depleting principal. It's incredible, and it's tax-free. Well, Congress made some laws in the 1980s. They're known as TEFRA, DEFRA, and TAMRA. You can learn about these on this YouTube channel. And that basically said you can't put in the full lump sum if you want to have tax-free income. It's always tax-deferred. When you die, it blossoms and transfers income tax-free. But if you want tax-free income, you cannot put that all in at once after June 21st, 1988 under that tax citation. And so the most you can put into a universal life, generally speaking, especially if you're over age 50, is about 20% a year. So that would be $100,000. So let's say you put in $100,000 the first year, and you can put in another 100. The second year, you can have up to 200,000 in there, then 300, and then 400. And then in 4 years and 1 day, you can finally put in the last 100,000. Since you slowed the flow, you took 4 years and 1 day to get the money in there. Now, forever after, when you take money out of this, it's tax-free. If your objective is to get the highest net internal rate of return as possible, you're doing the opposite of a normal insurance policy. Instead of trying to get X amount of death benefit for the least premium, you're trying to put in the most money that you want to be grandfathered. You don't have to. You're not obligated to put that much in, but that's what you want to do. You want to take the least amount of insurance the IRS will let you get away with. So I'm going to take a 60-year-old as an example. A 60-year-old could buy a grundle of life insurance with $500,000. I mean, you could buy millions. That's not the objective. The IRS says, well, if you're doing this for living benefits, the minimum would be a million, okay? A 1.25 million, okay? That'd be $1,255,000 of insurance. Now, that insurance, when you purchase 1.25 million, $1,250,000 of death benefit, and you put $500,000 in there, if your objective is to have the highest internal rate of return, in other words, in the 46 years that I've owned them, I averaged 8.2% from 1980 up until 1997. After 1997, indexed universal life came out. You can learn about that on this YouTube channel. And I've actually averaged 10.07%. But some years I don't earn anything. Other years I've earned 25%. But if that's what you're trying to do, then you want the cost of the insurance that the IRS says has to be there, or it will not be tax-free. It goes to another section of the code, which are taxable investments. And most investments are taxed sooner or later. Even IRAs and 401ks, of course, are taxed later. Then you want to have the least amount of death benefit. So at age 60, it would be $1,250,000. Now, option A, when I take it out, and by the way, you can switch the options anytime you want, as many times as you want. Option A says, hey, under these TEFRA and DEFRA tax citations, this money, this $100,000, $200,000, $300,000, the money I put in, this $500,000 can qualify as part of the death benefit. So that means if I put in $500,000 and I die, the death benefit is still $1,250,000. Okay? People say, what? Your money is part of the death benefit? Yeah, if that's your objective, is to have the highest net internal rate of return. Here's why. You put in $500,000, if now $500,000 of the $1,250,000 of required death benefit is your own money, the insurance company is only at risk for what? The remaining $750,000. They will only charge you for the amount that they are at risk, $750,000. Now, I put $500,000 into an indexed UL, and in 7 years, it doubles to $1 million. So now it's $1 million. Now they're only at risk for the difference between $1 million, which is my own money, and the remaining $250,000. And so they're only charging me for $250,000, the net amount at risk. Now, you take the $1 million, and it doubles in another 7 years to $2 million. Well, that's more than the original death benefit. So the tax citations, TEFRA and DEFRA, says, well, the death benefit now will grow with your money, and it has to stay 5% ahead of it. So when my $1 million doubles to $2 million of cash value, the death benefit is $2.1 million. So they're only charging me for $100,000 net amount at risk, and the charge for that is way more than covered with the interest on the $2 million of cash value that's tax-free. This is why option A will help you accumulate the most money, and basically the cost of insurance will go down as you get older. That's why it's the preferred option if that's your goal, is the highest amount of net spendable income. If you want to earn, like I have, 11 and net 10 on the average, you choose option A, the level death benefit, because you're self-insuring. So when do you use option B, and what is it? So with whole life insurance, a lot of times people tell you, or insurance agents say, well, don't you want the cash value added on top of the death benefit? Well, if you're doing it primarily to maximize what you leave behind, if your number one objective is maximize what you leave behind, yes. So option B says that when you put money in there and this money grows, $500,000 doubles to $1 million, and then $1 million doubles to $2 million, that cash value is added on top of the death benefit, the original required death benefit. So you're always going to be paying for $1,250,000 of life insurance. Now, insurance gets more expensive as you get older. So that's going to keep going up because you have to keep paying for $1,250,000 under option B. But if you happen to die, all your cash is added on top of that. But the cash won't grow as well as it could have if you allowed it to be part of the death benefit. But if you want to maximize what you leave behind, that if all your money growing to $1 million, $2 million is added on top of that, there's a trade-off. That means if you earn 11, you won't net 10. You might earn 11 and only net 6 or 7 or 8. But if you want to maximize what you leave behind, you may want to choose option B. When do we use it? Well, If somebody is going to primarily fund their insurance policy out of income and they want to put it in 7, 8, 10, 20 years, we might use option B to get more money in over a longer period, but there's probably going to be somewhere down the road where you will switch to option A once you've finished funding. It just simply allows you to be able to put in more money as you go. Or let's say you're under option A, and all of a sudden, and this has happened a few times, maybe 5% of the time with my clients, you find out that you are diagnosed with a terminal illness. When that happens and you know the doctor says you've got 2 years or less, you may want to switch to option B. That doesn't mean the original death benefit is added on top of your cash. It means whatever it is at the moment you switch, all cash value from that moment forward will be added on top of the death benefit, because all of a sudden your objective changed from, hey, I'm going to live 20 or 30 years and I want the highest net internal rate of return. I want every million to pay out, 80 to 100,000 a year. Now, if you don't care about it because you're not going to be around, you want to maximize what you leave behind, you can switch to option B, and the money that grows inside of there from that point forward is added on top of the death benefit to maximize what you leave behind to your beneficiaries. But that's about the only time we use option B, is if people sort of want to fund it, or they're taking money out of IRAs or 401ks, and instead of doing it in 5 years, in a strategic rollout is what we call it, they spread it out over 20 years. Well, then maybe you can choose option B to begin with. But generally speaking, if you're trying to have the greatest internal rate of return, the cost of the insurance be as small as it possibly can, as soon as it can, option A, the level death benefit, is the best option, because your cash qualifies as part of the death benefit and you are self-insuring. Pretty soon, the amount at risk is so small that the interest on all your money, tax-free, is way more than covering the cost of the insurance. The insurance is actually getting cheaper as you get older under option A. That is usually the one that we use. So if you've been going, whoa, I never understood this before, hey, I don't blame you. Most insurance agents do not understand what I just taught you. If you want to learn more, again, claim your free copy of this book, Laser Fund. It's a 300-page book with all kinds of charts, graphs, explanations, and you flip the book over. There's 12 chapters here with 62 actual client stories. You will learn about this and many other features of max-funded indexed universal life, and then you'll understand why option A is generally the best way to go. To get your free copy, you can click the link below. Go to laserfund.com. You simply pay $5.95 shipping and handling, and I'll pay for the book, and you pay for the shipping, and begin to learn and empower yourself on how to accumulate, access, and transfer your money totally tax-free.